This is Ysmaine, real estate agent here with eXp Realty, and this is another episode of Let's Talk Real. I'm your host, and here with me is Kelly. Hi, Kelly. How are you?
I'm great. How are you?
Very good, too. Excited to do another episode and teach some more things here about real estate. And today we're going to be talking about the right mortgage options for you and how to find them. So Kelly's going to be breaking it down, everything that you should take into consideration, when getting in the idea of let's buy a home and see what is available to you and what should your considerations be. But before we get into it, we're going to do a myth of the day. And today we're going to break up this myth, which is very, very popular. A lot of people think that a fixed rate mortgage is always the best choice. And that is not necessarily true, not to everybody anyway. So Kelly, can you expand on that for us?
Yes. So yes, a fixed rate mortgage is has the least risk involved in it. However, adjustable rate mortgages are definitely a thing. Right now, those interest rates are a little less than our fixed interest rates. When we first came out with them, they weren't much less. So it didn't really make sense for us to kind of sell those products to our customers or fit them into it, because why would you do an adjustable rate mortgage if the interest rate is the same as a fixed? Whereas right now, they are probably one to two percentage points less than our fixed interest rate.
That is huge. Yeah.
So interest rate, they're still not like super low like they were at one time, but they're still, when you're at that much of a difference in the percentage, it makes sense. It definitely with doing pre-approvals, because a full percentage point in your interest rate does make a difference in your payment. So
it could be up to $300 or so, with 1%.
Correct.
Pretty substantial.
Correct. So it would definitely help you with a pre-approval if you're looking for, maybe it's the home of your dreams that you're looking for. And right now you want a payment to be at a certain amount. Well, an adjustable interest rate mortgage might be the right fit for you. Yeah. But that's what we're going to go over today
to figure it out.
Figuring out what the right mortgage product is for you.
Yes.
So,
yeah. And just to kind of chime in on this too, I feel like if the person is planning on selling the house within a short amount of time, let's say less than 5 years, or if they know for a fact that they're going to be refinancing, this could be a great option instead of just going straight into a fixed rate. Of course, if the interest rates are lower, it makes sense financially. But this is a great option. And just to kind of expand on that too, there are different types of ARMs available. The types is really usually the timing. So you have like a 3-in-1, meaning you have 3 years before the fixed portion of that rate goes variable. And that's something that people don't understand. An ARM, an adjustable rate, is not adjustable from day one. Oh, I don't know if they can be or not, but most of them have a timing where you're 3 years fixed or you're 5-in-1, so you're 5 years fixed. I've seen as high as 15-in-1, which is the 15-year fixed, which means you could potentially be paid off depending how much more you pay monthly before that variable rate kicks in. So just keep that in mind. It's not variable from day one. You do have options, and each option you will have a different bracket of interest rate, levels there. And then if let's say the 5-in-1 works for you, and you're, the expectation is within 5 years the interest rates are going to go down, that would be a good one to choose, because then you can refinance when the fixed rates go down at that point. So let's go and figure it out. What is the right mortgage options for you? The first step is to assess your financial situation. And I'll let you expand on that too, Kelly.
Yep. So whenever I introduce myself to a new customer, I always ask them, where are you at in the process? Like, what's your situation? And a couple questions, have you examined your financial status, including your income, your savings, and what debts you currently have? We also like to look at how much you personally have comfortably calculated what you want your payment to be. Yeah. So it's all about getting to know you and where you're at in the process. Are you looking to purchase? Is this are you a first-time home buyer, or have you bought before and you have a house to sell? It all goes into your financial situation. Maybe you're coming into some money from a settlement, and maybe that's what you're waiting on. So sometimes with financial situations, it's a timing thing. If you're a first-time home buyer, some of the things we like to look at is, are you, looking to draw from your 401k, or are you looking to get a grant program? All this information is all part of it. So yeah. I usually advise my borrowers to write it all down. Look at where you're at, whether you put it into a spreadsheet or you handwrite it, see where you're at with your debts versus your income, because that goes into play with your debt to income ratio with a pre-approval. So
that's a good point there. Like, just putting it all down and writing it down to the penny, because a lot of people don't really think about, like, you're coming from a rental perspective. Your expenses on the renter might be and will be dramatically different than a home ownership, portion. So now you're going to have not just your principal and interest mortgage payments, you're going to have to include your homeowner's insurance and taxes, which is usually part of your payment. You're going to have to include all utilities. Maybe your rent includes some utilities that you don't have to pay, but now you will have to pay. You also should be kind of keeping in mind that there are maintenance requirements for your property in particular. So you might want to save a little bit for the rainy day, because there's always rainy days when you're a homeowner, yes. As we all know. So little things like that is you really have to give yourself a little bit of room, instead of just like, oh, Zillow told me that my monthly payment is going to be $1,800, and that's okay with me because I have $1,800 left over. Like, wait a minute. That's not all that is to it. Let's give yourself a little bit of flexibility, a little bit of wiggle room, so you're not leaving to pay the mortgage, right? You have ways to have a life on the side too. So putting it down really is a good tip from you, Kelly.
Yeah, and just to piggyback on that, like with the extra costs, I'll just use me as an example. Like, we have a street light thing that we have to pay for. You have to pay for like the fire hydrant, and they are little things that you have to pay for as part of where they do add up.
Yeah.
When we get
you in the city, and then the township comes over and said, "Oh, you have a crack on your sidewalk, and you were responsible for repairing. That's going to be like $2,000 to pay someone to do concrete work, and you were not expecting that. And right there is half of your taxes for the whole year. That you have to pay at once. So you never know with home ownership.
Yes, those little fees, they don't know. They may not be there when you first move into your house, because I don't know that we always paid the street light fee, but maybe we did. But that's sometimes they pop up because the township changes
the regulations. The rules. Yeah, exactly. And they will change, and taxes will go up. That's something else to keep in mind. You might start your mortgage payments for the first 2-3 years, and it will stay the same. But if the taxes do go up, your monthly payments will go up. So you got to be prepared to have, $100, $200 wiggle room on your monthly payments in case that does happen throughout the time that you're living in the property.
Yep.
Yeah.
So the next thing that we take into consideration is considering your long-term goals. And this kind of goes into play with what we talked about with the myth when we talked about the ARM product. So, how long do you plan to live in the house? If you only plan to live in the house for a few years, maybe it makes sense to do an ARM. to have the lower interest rate. Maybe you can, and then you can pay a little bit more on it if you're able to, or maybe you're only planning to live in the house for a few years, and then you want to move away and move to a bigger house. Then that's something else to think about with being into an ARM product.
Yeah. Or even like, for example, if someone is considering using like a grant, and that grant happens to have a little clause that says when you do sell the house, you have to, if you haven't lived in a certain time there, like the PHFA, for example, it is a forgivable loan as soon as you live in the property for 10 years, and it is forgivable 10% per year. But if you sell the house within 5 years, that means whatever grant you received, you still owe 50% of that grant. So when you sell, you're going to have to pay that back as part of your, selling costs. So something to keep in mind. Maybe you might not want to use a grant if you're planning on leaving the house in 2 years, right? It might make sense maybe to just come up with the money and not use the grant, because it would be more expensive on the back end of that transaction.
Yeah, and there are, I forget which county it is. If it was Dauphin, one of the counties does have a forgivable grant after 5 years, but it's not, the grant isn't as high as a PHFA grant. The PHFA, you get 5%.
I don't know if it's Dauphin or Cumberland County, that's 3 and one is 5, one or the other. And they're both, I think, 5 years.
But it's, one is forgiven and one isn't. So it's,
I can remember
every grant is different, but I know some of them are forgiven and some of them aren't. So, but that's definitely something that we would look into as part of determining which mortgage option is right for you.
Yeah. Yeah. That's all part of it.
So the next thing is understanding the mortgage types that are out there.
Yes, that's a big one.
It is a big one, because most mortgage companies offer your conventional, your USDA, VA, FHA. Those are the basic products that are out there. But if you are looking to move to a rural area, maybe USDA, and you don't have a lot of money to put down, maybe USDA is the loan for you, because it's 100% financing. You don't need a down payment for that. Yeah. And that's the same with VA. VAs have that bonus too. They don't have to put a down payment on the house. Now you can if you want to, but you don't have to.
Yeah.
And then we also have a lot of the grant programs usually coincide with the FHA product. PHFA, you can use PHFA with all the products, but a lot of the grant programs only allow FHA loans. But again, every grant's different, but what I've read over all of them, a lot of them usually only go with an FHA product. So that's something to think about, especially with FHA, because FHA can be very particular on the home that you're buying. Yes. So if you're a first-time home buyer, but you want to buy a fixer-upper,
not going to work with FHA.
Not going to work with FHA.
Yeah, unless you're talking fixer-upper as far as cosmetic goes, that's okay. Yes. But there are certain safety standards that are required by the FHA. And sometimes it could seem like a silly thing, like a peeling paint that for a fact was just done last summer, but it cracked, and now it looks like it could be lead-based paint. So FHA is going to force you to paint that or send it down and paint it again to be sure it's not lead-based. So little things like that. And so it may seem cosmetic, but it could be detrimental for an FHA loan type or any government loan type, to be honest, USDA, FHA, or VA.
Correct. And that's what goes into understanding the different mortgage types that are out there. Conventional is the least strict on the property. Yeah. However, they're a little bit more strict on you as the borrower. The debt to income ratio is much tighter with conventional versus FHA, VA. USDA does have a cap on their debt to income ratio. But FHA is very lenient on you as the borrower when it comes to your credit and, your history. So that's why FHA is a very popular first-time home buyer because you're just starting out. You're getting into understanding your finances. So
Yeah.
So that's why we recommend FHA for a lot of first-time home buyers.
And also on the lines of understanding the mortgage types and see if they're fit for what you're looking for. Maybe that one client may be looking to potentially get as much seller's assistance as they want. With a conventional loan, they're capped at 3%, so they wouldn't be able to do that. Or maybe they don't need that and they want to be able to get sometimes, just a home that needs more work. The convention would make more sense because they don't have to worry about not having that seller's assistance there. And also to kind of break the myth that we always get if someone is watching us for the first time, conventional loans do not always require 20%. You do have conventional loans starting at 3%, and then at 5, at 10, at 20, however much you want to put down. So there are different options for conventional. I have even seen special programs, but they're usually limited time only, and maybe for a specific banks that might offer conventional 100%. But there is a lot of criteria that needs to be met. So it's not something that is not an actual loan program. Let's put it that way. It's usually like some sort of offering from a specific bank. But there are options out there. So the common ones is conventional at 3, 5, 10, and 20, or whatever you want to put down. And there's different applicants when it comes to the requirements of the property standards itself, the seller's assistance option, and appraisal too. Actually, the PMI can change if you're putting more than 10% down. So if someone is looking to have a lower monthly payment, they might want to be using a conventional loan because they don't have to be paying mortgage premium that the FHA, for example, charges. So things like that. There's a lot of things that falls into the mortgage types that we need to understand to help you get the better option for what you're looking for.
Correct.
Yeah.
So the next thing is evaluating your credit score. So, some people follow this regularly. A lot of people don't.
Mm-hmm.
But credit score is a big factor when it comes to determining what product to put you in. If you have a little bit less than better credit, usually FHA is the way to go. There are ways that you can review your credit and watch it yourself. You can always have, if you have a credit card, lots of credit cards allow you to pull your credit yourself. If you do that, you want to make sure you're pulling from all 3 credit bureaus, Experian, TransUnion, and Equifax, because every lender pulls from all 3 and they use the mid of all 3 scores. So that's a big thing. You want to see where your debts are at and you want to pull a free credit report. A lot of credit cards will do that for you. Credit Karma is a good one. Credit Karma, they do have a system where if you need help with your credit, they can help you and coach you on how to bring it up. But just an FYI, if your credit is usually Credit Karma versus a lender's pulling credit, there's going to be probably a 20 to 30 point difference, usually. But again, Credit Karma is a great one to use. I've had a lot of customers use that to help bring their credit up. But looking at your credit and knowing where your credit score is at is huge because it does determine what would be the best product to put you into. It also, having better credit usually helps with the interest rate that you're getting. It also helps with paying less in mortgage insurance. Mortgage insurance has gone down a lot over the years. However, the better your credit, the less you're going to pay in that. So there's just a lot of things with analyzing your credit score and where your credit is at with your financial background that goes into play with purchasing a home. Mm-hmm. And I can help you with your credit. If you're looking to do a pre-approval, I always do a hard pull unless I'm asked to do a soft pull. But if we do a hard pull and there's some things on there, I can help you bring your credit score up. As long as you follow the instructions within 30 days of me pulling your score, I can bring your credit score up. I've helped many people with that. So that is definitely a big thing that we as lenders look at, and it's definitely goes into play with determining what's the right mortgage for you. So I'm not sure if you want to piggyback on any of that, Nini. But
Oh yeah, and I can vouch for Kelly. She has actually helped a lot of people, even between me and her with our clients. A lot of people come to us sometimes that they are nowhere near being able to approve for mortgage because their credit score may have been on the 500s, and then after a good time, Kelly's able to help them to get there. But yeah.
Can you pause it? So yes, I can definitely help to bring credit scores up if they are not where they need to be. So it's definitely something to keep in mind.
Yes.
It's a bonus, and it's free. Like there's
guys,
no charge.
there's no paying companies out there that honestly just steal your money. First, try to check Credit Karma, like Kelly said, that's a free app that you can use. But also call her. She's able, if you're like feeling like you're closer to where you should be. And by that, I mean like that low 60s, or even at 6, you can reach out to her and she can help you with that 30-day plan.
Yep.
And it does boost your credit a lot. So, just work it out with her.
Yep. So the next thing we need to do is determine your down payment. So how much?
Important one.
Yes. So, I do have a lot of people I talk to that, they have so much money for their down payment, but they also don't think about how much they have to pay in closing costs. So when you're thinking about
all the same thing.
Yes.
Oh, I have this much for down payment. Oh, okay. What about closing costs? Huh?
Yeah.
Yeah.
So unfortunately, that is it's not a myth. It's just people don't think about it.
Yeah.
And your down payment closing costs can be several $1,000s. Even at a lower purchase price of a home, it's still going to be a couple $1,000s.
Yeah.
Can't purchase a house without having closing costs.
Yeah.
So I always ask, how much money are you looking to put down? And when they tell me, and I'll say, well, is that total? And when I ask, is that total including down payment and closing costs? Because I always do a cost estimate when I do a pre-approval. And so that way you can see how much money it'll be to come to the table with in total.
Yeah.
So that's definitely something to keep in mind. If you're saving, just think about saving for down payment as well as saving for closing costs. Yeah. Sometimes you can get a little bit seller assist to help with that, or the grant programs that we talked about. Yeah. But just to keep in mind that, yes, you're going to have a down payment, but you're also going to have closing costs, and it's a total amount of money for settlement. So,
and I would say just be prepared. If you're planning on saving money for a purchase, be prepared to save between 3 to 6% towards closing costs alone. And then depending on the financing option that you choose, the loan type that you go for example, an FHA loan requires 3.5% down payment. So now you have, 3.5 plus 3 to 6% of closing costs. Now, Kelly mentioned seller's assistance is a way for us to minimize your cost, which can be negotiated. And in Pennsylvania, it's up to 6% of the purchase price that can be negotiated with the seller. It's not a guarantee. It's a negotiable piece. And depending on your mortgage type, I mentioned about conventional being capped at 3. You might not be able to get to 6, so you have to take that into account too. But yeah, so just keep that in mind as far as the total needed to do this purchase. Don't feel like you need to have the full total. I mean, if you do, it's great. But there might be ways that we can help you, like the grants, or you can have a family gift, or you could have the seller's assistance as part of your approval, or you can borrow against your 401k, or there's creative ways that we can try to go about it, and you can get creative and give you the options that might be available to you. But ideally, if you can save, the more you save, the better it is for yourself, just to put you in a better place to purchase, for sure.
Yes. Good. So, the next thing I would recommend doing because we kind of are getting through a lot of the different things with your finances, what to look at is to consult and compare mortgage lenders. I highly recommend checking with 2 to 3 different lenders. Every lender is going to have different fees, different interest rates,
different personalities. Sometimes you just want someone you click with. Yeah.
Correct. That it's all a relationship thing. You may talk to me and, you know, somebody else may have a close to the same interest rate. They may have maybe a little bit more fees, but you like that other person better. That's fine. You have to, I want you to trust me, and most lenders do. You know, you want to trust that person. You want to feel like, you know, this is a big purchase.
Yeah.
So you want to feel comfortable reaching out to that person with questions, you know. So I highly recommend checking with a couple different lenders just to see what the best fit is for you. Maybe you're that person that doesn't want to talk to somebody. Maybe you're just all about
very analytical, all about the numbers. Yeah.
Yeah. You know, maybe you're just about, you only want to do email, or, you know, maybe you just want to do it online. Like there's so many different things with different lenders. Every lender's different.
Yes.
So I highly recommend, you know,
choosing the right different too. So that's very important. So we mentioned this the last episode. I always ask for a cost sheet.
Yes.
So you can actually compare. There's no way for you to compare one lender to another just by a letter that says how much you're approved for, and maybe they will tell you what interest rate you're getting, because that is not a true comparison. Because they could be giving you an interest rate that is deceivingly low, but they forget to tell you that they might be charging you points, which will cost you a couple $1,000s more to get to that rate. While the other lender might have a quarter higher interest rate, but they are charging you 0 for that interest rate. So that's why cost sheets are so important for that reason and many other reasons, because some lenders have 300,000 fees that they charge. Some lenders don't charge many fees. Like I know Kelly's with Sierra, and Sierra does not charge as many fees. So we know, like, okay, this is it, that's it. Like there's like 4 fees there, and you know what they are, and they're fixed. So it's good to be able to compare, because maybe, you know, that lower interest rate might end up costing you.
We only charge 2
more. You only have 2. There you go. You know, I was just kind of throwing it out there.
The other fees that we charge, every lender charges, are fees that go along with your interest rate.
Yeah.
And like other small fees that have to be done for a mortgage. But like us, we do have our underwriting and our processing fee, but that's it.
That's it.
But yeah.
Oh yeah, some lenders charge notary fee, technology fee, something else fee, title search fee, credit report fee. I mean, there's like so many different fees, and I'm just naming a few, but there's tons. And I'm like, wow, they get creative with this. And
yes.
It's like 30, 40, 60, 100 here and there. And then when you look at it, it's like $3,000. I'm like, what?
Yeah.
So please be mindful, and actually do talk to more than one, at least 2. I would say that's like, you know, at least. But don't go talking to 5, because that's not good either. Like it's not going to benefit you when you get to that number. But I would say 2, 3 are a healthy, you know, amount of people to talk to.
If you go to too many, you can get confused.
Yeah, you will get confused. Yeah, because choose your top 2 and 3, and then compare those and go from there. And I feel like personality-wise, that click, that kind of trust feeling, it plays a big role, especially when purchasing a home. Yes, it is about the numbers too, but it's also about like, okay, do I feel comfortable with this person and sharing all my financial profile with this person, you know? So it's important to feel that connection too. And if you ever need like recommendations, sometimes people don't get overwhelmed because there's so many banks, so many lenders out there. You know, if you have a real estate agent, they will be able to provide you with their top lenders. Like I have Kelly, and I have, you know, other ones that I can recommend. So I have my preferred ones. Another realtor is going to have their preferred ones. And usually it's the best people that we've worked with. So we are able to make those recommendations to you if you feel like you're getting overwhelmed and don't know where to go. A real estate agent would be your best option to request those referrals.
Yep. So the next thing is considering your risk tolerance. And this would be your level, like at your financial risk. And we kind of talked about this in the beginning, with the adjustable rate mortgages versus fixed rate mortgages. Like I mentioned earlier, fixed rate is the least risky mortgage versus an adjustable interest rate mortgage. That's an adjustable interest rate mortgage is risky because, like we mentioned, it would be fixed for a certain amount of time, whether it's 3, 5, 7, 10, 15. But after that time is up, your interest rate becomes adjustable, and it adjusts based on different indexes and
in the market.
In the market. So, but depending on where you're at with how you feel and where, what your goals are with your finances, maybe an adjustable rate mortgage is the right way to go because you only plan to live in the house for a few years. I'll use myself as an example. When I first bought my house, we went into an adjustable rate mortgage because at that time, for me, that was the best payment option because we went into a 3-1 ARM. And that the interest rates were super low at that time. And I was planning on refinancing prior to that because there are no prepayment penalties on ours. Mm-hmm. So, we were getting close to the end of that 3 years and we were in a better financial situation after 3 years of living in the house. And we refinanced into another 30-year fixed with interest rates weren't bad, but they still weren't as low as our 3%. So that was our risk tolerance in my particular situation. But maybe that's not the case for you. Maybe you want to be in an ARM because you're going to be coming into money. You're going to be coming into money later on. Or maybe you don't plan to live in the house for that long. So you're okay with being a little bit risky with being in an adjustable rate mortgage because you plan to sell within the 3 to 5 or however many years you decide to go into it. Okay. So it's definitely good to analyze, how risky you want to be with your mortgage because it's definitely something that goes into play with it. I would say that pretty much sums up, risk and how that goes, which, our next thing that we want to talk about is factoring additional costs, which we kind of we did talk about this briefly because when you're owning a home, you have other costs. We talked about all the other.
Yeah, we did kind of sort of talked about that on the first item, but you're definitely going to have something else to account for. We can mention the additional ones too, like for example, homeowners association. We didn't bring that out. So depending on the house you choose, if your house you like happens to be in a community, you may be paying, an HOA community fee at your month. And that could be, anywhere from $10 a month to maybe even $250 a month. At least here in Pennsylvania, I've never seen much higher than that.
But the thing about that is, just a real quick thing, sometimes if you have an HOA, it kind of takes care of maybe some other fees you don't have to worry about.
That's true, like cutting the grass.
Sometimes even trash. Yep, trash.
Yeah.
But it is definitely an extra cost. I don't, every place is different, but it does offset some things depending on where you live.
You could,
Some do, some don't. I think it all depends on the community that you move into, but that's definitely a big one.
Yeah.
Did you have anything else to add on to?
No, I think we did mention just to reiterate what we said on the first one, we mentioned the homeowners insurance, because you might have had renter's insurance, but that's usually much lower than the homeowner's insurance, especially depending on the type of house you're going into. Your renter's insurance maybe was $600 a year. Now you're going to a home, maybe that home is $1,200 a year, right? And that's going to be part of your monthly payments for your mortgage. So we're going to let you know, but that's going to impact that monthly payment for you. So that's something we should take into account as well. And And all the utilities.
Utilities or flood insurance.
Flood insurance,
Flood
yes.
is definitely a big one.
It is a common one, yeah.
In a flood zone, that is definitely can be high expense. Unfortunately, flood insurance
Could be.
is
One
not.
other one that people don't think about and is not required in most areas, but in, for example, Palmyra area, it's very popular, is the
Yes.
sinkhole insurance.
Oh yes, sinkhole. Yes.
Sinkhole has some lenders may require depending on the area. I just know that I think Palmyra is the only one. I don't think it's a requirement. It's a big recommendation. Your homeowner's insurance might be higher if you don't get the sinkhole insurance in the area. And the sinkhole insurance is not very expensive, but it's an additional expense as well that you could be running into.
But that's something to definitely like with your insurance. Your insurance person should know that. Your insurance agent should definitely know what areas are. I know our insurance guy knows.
People know.
He knows the different areas where.
Yes, we are talking about Bill. From Bill's Head Insurance. Wink, wink.
So he definitely is very good about different areas in Pennsylvania that are in flood zones or where there's sinkholes like Palmyra, so different things. So that's definitely a big one to think about with the additional costs.
Definitely.
So another piece of this is seeking professional advice, maybe from a friend.
You got to talk to me. I'm just kidding.
Well, yes.
But I'm not kidding. It's true.
But this part of this is speaking with like a financial advisor as well.
That's you.
Just to see, purchasing a home, maybe you already have an advisor. Maybe your advisor works with a realtor like me that can help. But it's always good to, whenever you're purchasing anything big like that, if you have a financial advisor, it's definitely good to talk with them about it to see how it fits into your retirement plan. Because everybody should have a retirement plan for sure.
Yes.
But also your real estate agent, they are also a big part of it because they can help you with the different costs and the different fees, that they charge, but also what comes along with a home. Yeah. There's lots of things that you do that I don't do when it comes to just like a VA loan, like you order some of those inspections that need to be done, and a lot of them have to be paid up front. So like there's different professional advice that and I'll just let you elaborate on it because you're the real estate agent. I am not.
Yeah, when it comes to the real estate portion, I mean, just talking to your realtor first, we can kind of, if you're not already connected, for example, with a loan officer like Callie, we're going to be the ones kind of the first step on explaining to you what to expect, what the process is like, areas you can be looking at depending on the schools you're interested in or not, what the price ranges averages are right now, what kind of market you're getting yourself into depending on which time of the year you're getting yourself to purchase. We're going to strategize timeframes based on your needs. So maybe your rent is up in December and it's October now, and you're like, can I get into a home before then? We're going to try to come up with a plan of action to make it happen. So there's a lot of things that go into talking to a real estate agent first. And I feel like majority of the times we ended up being that first, tier of contact for any buyers out there. Or sometimes it goes to the loan officer first and then comes to us. We're like first and second here when it comes to, who we starting
They
with.
usually go to you first.
Usually, I think I would say we're like that first face that they see, mainly because, again, buyers are usually doing things backwards and they're looking for houses first. So they end up being connected to an agent for a showing. And that's how that first connection happens. And then we kind of, knowing the process, we adjust things up and we connect you with the loan officer so we can get your pre-approval first and then start shopping. But at other, like she said, financial advice is a great professional advice that you should be taking care of. We even had an episode with one of our dear friend here, Bill Zerillo, he's a financial advisor as well. That we're talking about retirement and whatnot. So it's a very good another type of profession that you should be reaching out to for advice to get ready. Real estate loan officers, even an attorney, depending on your situation. Maybe the house you're looking to sell a house that you inherited from a probate, right? So maybe that's your situation. You might be talking to an attorney for that reason. It could be a divorce situation. So there's very many different scenarios that a buyer or seller could be reaching out to get advice. But yeah, so this would be that point to reach out to those people to get personalized guidance.
Yep. So another big thing is reviewing the fine print. So you want to make sure that you understand everything that comes along with your mortgage. I have some clients who read every word and question every single thing on a document, and then I have others that
sometimes too much, right?
Sometimes too much, and sometimes I can't always explain everything in complete detail, but I can give definitely a good educated response on a lot of the stuff that's in the fine print of our loans. But it's definitely a good idea to understand how your mortgage works. If you want to, there's a couple things that you can do to help pay down your mortgage and lower your term, but there's other things that go along with your mortgage, like we don't charge prepayment penalties. That's something you definitely want to ask. And I do have customers ask me that. We don't charge it. So if you want to purchase a home, you can pay it off sooner than the 30 years. There's no prepayment penalty. Some banks still charge them. It is still a thing. But it's definitely something, you want to make sure you understand what you're getting to, especially if you get into an adjustable rate mortgage. So that's something, because every adjustable rate mortgage, every companies are different. So you want to make sure you understand how they work. Can you refinance out of it? When should you refinance out of it? How does the interest rate work? How long is it fixed for? And then what happens after that fixed time period? There's a lot of things with an adjustable rate mortgage you definitely want to read the fine print on. But even with the different government loans, like understanding, FHA does charge mortgage insurance premium that depending on how much money you're putting down on the property, you're going to pay for the life of the loan. Lots of people don't understand that. There's also you also have mortgage insurance with FHA that will drop off at 78 or 80% if you call in and have it dropped off at 80%. Yeah. But the mortgage insurance premium, that's usually something you pay upfront for an FHA. With USDA and VA loans, USDA, you do have a fee that you do. It's very minimal fee that's added to. You have like your base mortgage, but then you also have your final mortgage with the USDA, because there's a USDA funding fee that gets put into the mortgage that you pay over the life of the loan. But you're also you don't have to put a down payment on it. So that's kind of the trade-off for USDA. Yeah. Same thing with VA, unless you're disabled. If you are a disabled veteran, your
the VA funding fee
is waived, and you do not have to pay that.
And you also might be partially disabled, and that also gives you a discounted VA funding fee as well. I think the biggest fine print is it's still a pretty great product, so I don't think anybody would not use VA because of the VA funding fee. But one thing to keep in mind reading the fine print is that the second time, let's say you bought a house with primary residence with VA, and then now you're getting ready to buy a second house, you're going to sell the first one, you are allowed to do that. But the second time you use the VA funding fee, your VA funding fee is higher, much higher. Yeah. And then maybe at that point, it may not make sense for you to add an additional $12,000 to your loan amount, right? Some people may not want that. They may prefer to get a regular loan where they don't have that amount. So understanding that and then making that choice is important. That's why fine-tuning is definitely something, to keep an eye out, those little changes that may happen.
And ask questions.
Yes.
Always ask questions. That's what we're here for. Whether it's a question about the property, that's usually an ENI question.
Yeah.
Anything with your loan, always ask.
Yeah.
That's
honestly, you asking almost help us too, because there are things that we know and there are things, trust me, that we do not know. And then when you do ask us, we can find out. And now there he goes. Now we know. Because this last few years, I'm pretty sure that you have learned so much, and I have learned so much just from clients, putting themselves and us in situations. I'm like, oh, okay, I just learned something new. That's great.
Yep.
So do ask questions. That's very important.
Yep. So the final thing is matching your mortgage to your needs. And I feel like all these steps that we went over today, review how we do that, what the right mortgage is, because the right mortgage for me may not be the right mortgage for you. But that's what I'm here for. And that's why I review all these different things. So I put you into the right situation. And I know sometimes people are like, I'm like, so what are you looking to do? Where are you at right now? A lot of people are like, well, I'm looking to buy a house. Well, I get that, but let's talk about, where you're at. Let's talk about your finances, and that's just me getting to know you, and where things fit, or any lender that you talk to, they need to understand where you're at in the process.
Yes. And I feel like after we went through all these steps, now I think the person probably listening to this can understand why when like someone come to us and say, oh, but my cousin bought a house and they only paid this much and their interest rate was this much. Now you can kind of see why that doesn't mean anything, right? Because everybody's is going to have a different profile, right? And it's almost like fitting a perfect shoe to the perfect feet. It's going to vary from person to person. Yes, the same programs may be available, same programs may be used, same type of loans may be used, but you are never going to be getting the same exact thing as someone else, because you have a different life than that person, despite whether you're the same family, right? You're just going to have different expenses, different everything. And then that will make a difference on what kind of mortgage and grants and fees and interest rates you might be getting from purchasing, and also the different house, because you're not going to be getting the same exact house as that person. So just the house alone can make a huge difference, as we spoke to you guys about condition and whatnot. So very, very interesting to see, and understand how everything makes you find the perfect mortgage for you specifically.
Yep.
So that was a pretty comprehensive one. Do you want to add anything to it?
I don't think so.
Yeah.
I think we kind of covered a lot.
We did. And if you guys watching have any questions or would like to, get started with your mortgage process and look for a new home, you can get in touch with me, Kelly. Kelly can help you with your credit score needs, getting your pre-approval, or just really explaining what could be an option for you.
Yep. And don't wait. There's no reason to wait. If you are thinking about purchasing a home, don't wait. Talk to somebody about it.
Yes. Seek professional advice. Skip right to, what is that, step 9?
Right.
Talk to us. We'll help you with the rest. Alrighty, guys. Thank you so much for watching. You guys have a great day. And
yep.
next.
All right. We'll see you.